What's up, team? This is Ro, your best friend at JMSB. I know a lot of you guys are studying for your COM 305 Introduction to Managerial Accounting final exam that's coming up. One of the questions that usually shows up on this exam involves budgeting. And so to help you guys out, I've set up an example here to show you guys how the budgeting process would be conducted for a manufacturing firm. Let's have a look. Great Savers Tutoring Inc. has projected sales for its course packs in units for the first 4 months of operations in the year 2019 as follows. And so we're offered the unit sales for the months of January, February, March, and April. It tells us that the firm sells its course packs for $20 per unit. 15% of customers are expected to pay in the month of sale and take a 2% discount. 80% are expected to pay the month following the sale, and the remaining 5% are expected to be uncollectible. The ending balance sheet for December 2018 indicated that the firm had trade receivables outstanding amounting to $12,000. These receivables are expected to entirely be collected in the month of January. So far what is being offered to us is information that we need for our sales budget and our schedule of cash collections from customers. So these unit sales, along with the collection policy that's described below, is going to be used to prepare a sales budget and a schedule of cash collections. If we continue to read, lower down it tells us that it takes 10 sheets of paper to produce one course pack, and the firm acquires paper at an average cost of 5 cents per page. The ending balance sheet for December indicated that the firm had 1,000 worth of paper in raw materials inventory carried at a cost of 5 cents per page. Great Savers' policy is to end each month with enough materials to cover 20% of the following month's production needs. The firm pays for 40% of its material purchases in the month of purchase and the balance in the month following the purchase. The ending balance sheet for December indicated a trade payable balance of $5,000. So the information that's provided in this paragraph tells us that we're dealing with a manufacturer, and that's simply because a manufacturer is going to be purchasing raw materials or direct materials, whereas a merchandiser purchases ready-made inventory. And so the information that is offered in this paragraph here is going to be useful for us to prepare a direct material purchases budget and a schedule of cash disbursements for purchases of materials. If we continue to read, lower down it tells us that it takes the firm 0.25 hours of labor to produce each course pack, and labor is paid at the rate of $20 per hour in the same month as when the units are produced. Manufacturing overhead is estimated at a rate of $2.5 per unit and an additional $30,000 per month, including depreciation of $8,000 each month. All overhead costs are paid for as they are incurred. In this paragraph, we're offered information about other disbursements that are going to happen for product costs. So not only is the firm going to be paying to buy DM, they're also going to incur things like direct labor, variable overhead, and fixed overhead. And so the information here is going to be used on our cash budget under the cash disbursements section. If we continue to read, lower down it tells us that Great Savers Tutoring Inc. will begin January with 12,000 worth of finished goods inventory, representing 2,000 units. Great Savers management wants to end each month with 25% of the next month's sales in ending finished goods inventory, and no work in process inventory. The firm is expected to begin February with a cash balance of 100,000. In this last paragraph, we're offered information that would be useful for our production budget, along with the opening balance in cash for the month of February, which we're going to be placing in our cash budget directly. So now that we've gone through the example and we've sort of dissected the information as to where it's going to belong, let's start tackling the required. So the question is essentially asking us to prepare a cash budget for the month of February, and obviously in order to do that, we're going to have to do all of the steps that are needed for the budgeting process. We can't just make the cash budget right away, simply because we're going to need information from our other budgets in order to prepare the cash budget. Now, one piece of advice that I could offer you is that regardless of which month that they're asking for, whenever it is possible, you should create budgets for as many months as you can, and you'd rather shave off months as you go through the process then have to add months later on. And that's simply because some of the values for a given month are going to be dependent on the next month. So for example, if I wanted the ending inventory for March, I would need to know values for April. And for that reason, it's strongly recommended to do that. You should always start off by making as many time periods as you can. And then as you go through the process, you'll realize you're sort of shaving off time periods. And by the end, hopefully be able to get all the values that we need for the month of February, which is the time period that they're actually asking for the cash budget for. And so now that we've understood that, let us start the budgeting process for this manufacturing firm. The very first thing that I would tempt you guys to do is to set up a sales budget and a schedule of cash collections from customers. In order to do that, we're going to be looking at the information that's offered here in the first paragraph. We're going to need our unit sales, we're going to need our unit selling price, and our collection policy for sales. Using that information, we're going to prepare these two schedules. So the very first thing I would do is I'd set up the months going across. We've got the months of January, February, March, and April. From the problem itself, I'll grab the unit sales. So we're offered the unit sales data for each month. We have our unit selling price, which was $20 per course pack. And now all we want to do is multiply the unit sales by the unit selling price in order to obtain sales in dollars. And so if I were to multiply 25,000 by 20, I'd get the sales for Jan. 30,000 by 20, I'd get the sales for Feb, and so on. Now that we've understood what our sales are, the idea is to go through the problem and to identify the firm's collection policy for sales. We're essentially trying to figure out when will the firm collect cash from all these sales that they're going to be making. Every firm is going to have a different collection policy, and so it's not recommended to memorize the schedule, but rather to understand it. Whatever the collection policy may be, you're simply going to write it out in the first column of your schedule. In this particular example, it told us that 15% of sales are going to be collected in the month of sale. Moreover, on those sales that are collected in the same month, we're offering a 2% discount. And then finally, 80% of our sales are going to be collected the month after we make the sale. And so we now want to apply this collection policy to our dollar value of sales. I can simply multiply these sales dollars by 15% to figure out how much will be collected in the same month. So 15% of $500,000 is $75,000, 15% of $600,000 is $90,000, and so on. And now on all these cash collections that are made in the same month, we're going to be offering a 2% discount. Since this is a discount, it implies that cash is not coming in, and so I'd recommend to put it as a negative. So 2% of 75,000 is 1,500, 2% of 90,000 is 1,800, and so on. For the month of January, the 80% that's collected is going to represent the trade receivables from the prior month. So in our example, it told us that the ending balance sheet of December had a trade receivable balance of 12,000. That 12,000 that's outstanding from December is going to be collected in the month of January. So this 12,000 is our opening trade receivable. And now in the month of February, we're going to be collecting 80% of what we sold in Jan. And so 80% of 500,000 is 400,000. 80% of 600,000 will be collected in March, so that would be 480. 80% of 700,000 will be collected in April, and so that would be 560,000. Now that we've applied this collection policy, the idea is to add up all of the cash that is coming in. And so when we're adding up the cash collections, make sure you don't add your sales, only add the cash that is coming in. If it's a discount, be sure to minus it. And further realize that if there are any uncollectible sales, we're simply not going to place those on our schedule because that's not cash that is coming in. So I can calculate the total cash collections from customers simply by adding the 15% that we collect in the same month, minusing the discount, and the 80% that we're collecting from the prior month's sales. And so at this point, we should have successfully finished our sales budget and our schedule of cash collections. Now that we've done that, the next step is to set up a production budget, a DM purchases budget, and a schedule of cash disbursements for the purchases of DM. I'd recommend to prepare these 3 schedules all together, and that's simply because the last line of each schedule makes up the first line of the next schedule. So once again, I'm going to list the months going across. So we've got January, February, March, and April, and we're going to begin with our production budget. Our production budget is going to start off with our unit sales. We're going to add the desired ending inventory, which in this example was at 25%. We're going to less the beginning inventory, and this is going to tell us the units to be produced. The unit sales are simply going to be taken from the very first step. So in the first step, we have our unit sales for each month. I'm simply going to recopy those in the first row of my schedule. And now in this example, our ending inventory policy for finished goods was at 25%. So at the end of each month, we want to end off with 25% of the unit sales for the next month. So at the end of Jan, we're going to have 25% of 30,000, which would be 7,500. At the end of February, we're going to have 20% of our unit sales for March. So 35,000 times 20% would be our ending inventory in February. And in the month of March, we're going to have 25% of what we expect to sell in April. So 25% of 40,000 is 10,000. Notice that we can't do the month of April. However, we needed the month of April in order to obtain the value for March. So after this step, we're essentially going to shave off the month for April. Our beginning inventory in January is for 2,000 units. Try to be very careful. Sometimes they tell you the dollar value of the finished goods that are available at the start. What you really need is not the dollar value, but rather the number of units. The beginning inventory for the month of February is simply going to be the ending inventory of Jan. So the 7,500 that we ended off with in Jan, we're going to start off with in Feb. And that same logic can be applied to the month of March. So the ending inventory of Feb becomes the beginning inventory for March. And now we simply want to apply the schedule. We take our unit sales, we add the desired ending inventory, we less the beginning inventory, and this is going to tell us the units that we have to produce each time period. The main difference between a merchandiser and a manufacturer is precisely this. A manufacturer is going to prepare a schedule for units to be produced. This is the only schedule that is entirely made in units. Realize that there isn't a single dollar amount that appears on this schedule. Now that we know how many units to be produced each time period, the next step is to plan out our purchases of direct materials. So using the units to be produced row, we're now going to set up a schedule for DM purchases. The way that we do that is as follows. We take the units to be produced, we multiply them by the DM needed per unit. This will tell us the DM needed for production. We then add the desired ending inventory, which in this example was at 20%. Understand that this is the desired ending inventory, not for finished goods, but rather for direct material. We then less the beginning inventory of DM, and this is going to tell us the DM to be purchased. Once we know the amount of DM, the quantity of DM we're going to be buying, we simply multiply that by the DM cost per unit, and this is going to tell us the purchases of DM. In this example, it told us that every time we make a course pack, it requires 10 sheets of paper. And so if we multiply the units to be produced by 10, we're going to be able to calculate the DM needed for production. We're then going to add the desired ending inventory, which is going to be a percentage of the following month's production. So at the end of Jan, we want to end up with 20% of the units that we're going to be producing in February. So 20% of 312,500 is going to be 62,500. 20% of March, which is 362,500, is going to be our ending inventory for Feb. So that would amount to 72,500. So notice now how we needed March to be able to do the month of February, and we can't continue with March because we don't have the production for the month of April. So since we have two different ending inventory policies, for a manufacturer, we often have to make more than one time period beyond the one that is asked. So we were only asked to make a cash budget for Feb, but in order to do that, we had to set up the schedule for March and April. So like I said, Right off the bat, it's a good idea to do as many time periods as you can, and then as you go through the process, you start shaving off time periods rather than realizing at this point that you should have done those months to begin with. Our beginning inventory in January is the ending inventory at the end of December, and be careful, we don't want to put a dollar amount just yet. We want to know the amount in units. And so in this example, the ending inventory in December was 20,000 units or sheets of paper of raw materials, which is going to be the beginning inventory for January. Be very careful, we don't want to be putting dollar amounts just yet. What we'd rather have is unit amounts. And so in this example, they told us that the ending inventory of DM in December was $1,000 worth, but because this DM is purchased at 5 cents a unit, we can simply divide 1,000 by 5 cents to understand that it's in fact 20,000 sheets of paper rather than $1,000 worth of paper. So now that we've understood that, we can realize that the ending inventory for the month of January is going to be the beginning inventory for Feb, and we can sort of stop there simply because we're not going to be continuing with March. At this point, we can add up all the DM that needs to be purchased. It's simply going to be the DM that's needed for production, plus our desired ending inventory, minus the beginning inventory. Once we've figured out how much DM to be buying, we're simply going to be multiplying this by the cost of DM. So in this example, as I explained earlier, the sheets of paper cost us 5 cents a sheet, and so we can multiply these by 5 cents, and this is going to tell us the purchases of DM. Now that the firm has planned out how much DM they're going to be buying, the next step is to figure out when are we going to be paying for all of this DM. And at this point, what you're looking for in the problem is essentially the firm's payment policy for purchases of DM. Once again, every firm is going to have a different payment policy. So in this case, we pay for 40% of the purchases in the same month, and 60% is going to be paid 1 month after the purchase. And so we're going to apply this payment policy to our purchases of DM. I can multiply the purchases for Jan by 40% to realize that I'm going to pay 40% in the same month, so that would be $69.50. If I do the same with our purchases in Feb, I'll get $64.50. Moreover, in the month of January, the 60% that's going to be paid is going to be the outstanding payable from the prior month. So December's ending trade payable is what we're going to be paying as the 60% for January. In February, we're going to pay for 60% of the purchases that we made in Jan. And so 60% of $17,375 is going to be the amount paid in February. So now that we've calculated all that, we can calculate the total cash that is paid for the purchases of DM. So when we're adding these up, make sure you don't add the purchases, only add the cash that is actually going out. So our total cash disbursements for the purchases of DM would be $11,950 in January and $16,875 for the month of February. So there we have it. At this point, we've successfully produced a sales budget, a schedule of cash collections from customers, a production budget, a DM purchases budget, and a schedule of cash disbursements for the purchases of DM. And now that we've done that, the final step is going to be to set up our cash budget. In this example, we're only asked to make a cash budget for the month of February, and so I'm going to set up a title where I've got the cash budget for February 2019. Our cash budget is going to start off with the cash balance at the start of the period. In this example, we were told that the beginning cash balance would be $100,000. We're then going to add the cash collections from customers. We'll obtain the cash collections from customers from our schedule of cash collections. So we're just simply going to look at the last line for the month of February, and we can add the cash collections from customers. If there's any other reason why the firm collects cash, we'd simply put that in this section. For example, they could collect a note receivable, they can sell off assets and have some proceeds from sale. In this particular example, we don't have any of those things, but if we had them, we'd include them in this section. We'd simply list them after we've got our cash collections from customers as other line items, so we could have other receipts. Once you've listed all the inflows of cash, you can simply add them together, and this is going to tell you the cash that is available. So 100,000 plus 488,200 would tell us that the cash available for the month of Feb is 588,200. And now lower down, we're going to set up a section for our cash disbursements. So here we want to list all the reasons that the firm would be spending cash. One reason is going to be for the purchases of DM. And so we can look at our schedule of cash disbursements and see that in February, we spent $16,875 in order to buy direct materials. And now beyond that, you want to list any other reason that the firm is spending cash. So in this example, we have disbursements for labor. I remind you that labor was $20 per hour and that it took a quarter of an hour to produce each course pack. So the way that we calculate this amount for labor is simply by multiplying the units to be produced for the month of February by 0.25 and then by 20. And so that's because it takes quarter of an hour to produce each course pack, and labor is paid at 20 per hour. So just to be sure that you guys understand how I got that value, I remind you once again that I simply took the units to be produced for the month of February from our prior schedule. I multiplied this by the amount of labor hours that it takes to produce one course pack, and then by the cost of labor. The next item that we're spending money on is for variable overhead. We're told that variable overhead is $2.5 per unit, and so we're going to multiply 2.5 once again by the units produced to obtain the variable overhead for the month of February. Finally, the only other cash disbursement that was mentioned in the problem is for fixed overhead. Now the fixed overhead sometimes includes the depreciation, and sometimes it's listed separately. Try to realize that we want to put the amount that is going to be spent in cash, and depreciation is a non-cash item. So in this example, although the fixed overhead was $30,000 each month, it included $8,000 of depreciation. So the amount that's going to be spent in cash is really going to be just $22,000. So once we've listed all of our cash disbursements, we can kind of add them up and write their total in the farther column. So the total cash that is going to be going out of the firm in the month of February is going to be $273,250. Finally, we can take the disparity between the cash that is available and the total cash disbursements in order to figure out the ending cash balance for the month of Feb. So there we have it. This would be the cash budget for this example. So I'm hoping that this explanation helps us. I'm hoping that you guys now understand how a manufacturing firm would prepare budgets that are slightly different than those that would be made by a merchandiser. So I'll be posting the question and the answers to this question in the comment section of this post. If you guys found this video helpful, make sure you tag your friends that are taking COM 305. I'm sure they're going to be able to benefit as well. In the meantime, I hope you guys keep studying well and kick some ass on your exam that's coming up. Row out.